Good morning, everyone, and welcome to our DAT IQ weekly market update.
Yep.
It's our last update for 2021. It's December 21st. I want to welcome everyone to the show. I'm Ken Adamo, Chief of Analytics, joined by Dean Croak, who's our Principal Industry Analyst, and we have a new face to the show. We have Chad Kennedy, who is one of our Senior Product Managers here at DAT. Good morning, guys.
Morning.
Hey, Ken. Welcome, Chad. Great to have you with us. Yeah.
So the big question looming, favorite Christmas cookie? Dean.
Favorite Christmas cookie is it's a shortbread with a lemon meringue filling.
Ooh, that sounds good. Chad.
Ooh, that is good. I'd have to go with pecan sandy. Yeah.
Oh, those are good.
Yeah.
We go nuts. I mean, between the two Italian families and ours, we make hundreds of dozens of cookies. So I'd have to say mine's probably a maple twist. They're like a little mini cinnamon roll looking thing, but it's maple and they're delicious. It takes my mom all day to make a batch of them though, so we only get them once a year.
Cool.
So for those new to the program, we're here every week talking about the freight market, answering your questions. So go ahead and drop them below. We're gonna get a little outside the box today, break a little rules and show some of the cool stuff we're working on. That's why we have Chad on the show. He's gonna come back in towards the end and give us a little bit of a static demo of something that's really awesome we're working on. So I'm looking forward to that. But before we do that, we absolutely have to do our typical routine. And so for that, I'm going to go to key trends of the week. So where we are from a rating perspective, things are pretty much as high as they're going to get for the entire year. Pretty much flat, but at rather extreme levels for dry van and reefer anyway, leading into when the big man comes down from the North Pole this weekend. Flatbed's an interesting thing, right? So you have all of the mechanics around the energy markets, but then you also have kind of that winter boom, if you will, that little mini peak of housing starts down south. So that's interesting to track. It'll be really interesting as we head into next year to see what interest rates do and how that applies a rather large lever on housing. Used truck prices up. Cancellations also up for new Class 8 truck orders. Dean may touch on that, mainly driven by OEMs, not purchaser cancellations. Continues to be a ton of boats in San Pedro Bay. And today's the winter solstice. I guess I forgot about that. Shortest day of the year, in my opinion, the most miserable day of the year. But the days only get longer from here on out. So that's always positive. So with that, I'll turn it over to Dean, and he will walk us through the market update. Dean?
Yeah, it's certainly the turning point. We've got some, hopefully, more sunlight ahead of us, which is great news. So let's start off with our load board activity in the dry van sector. Load board activity slightly higher last week. Of course, brokers were looking for a lot more additional capacity for those last-minute loads leading up to last Saturday, which was the last Saturday before Christmas. There were fewer carriers posting as we'd normally expect, so the load-to-truck ratio moved up slightly from 5.46 to 5.91, not a big movement upwards there. And in the refrigerated sector, obviously a lot more activity in the refrigerated temperature control space, a lot more holiday celebrations, planning and inventory replenishment. Loads moved in that sector were up 11% last week. There were fewer equipment posts, same as the dry van sector. So the load to truck ratio actually reversed course last week in the reefer sector, up 16% to 10.50. In the flatbed load board activity sector, loads moved on our top 78 busiest lanes. Decreased by just over 1% last week. Load posts were down by about the same volume. Equipment posts were also down last week, so that moved the load to truck ratio to 48.76. So taking a look around the country at our heat map for the market condition index, Ken touched on some of the port activities. That a lot of that volume, of course, is not going to clear before the holiday season, shopping season wraps up. But there was some pretty bad weather last week out in the sort of the Sierra Nevadas, we'll call it, on the I-80 coming out of California. That lasted most of the week. Carriers were shut down for quite a few days. Spot rates in those snow-affected areas, particularly over Donna Pass from Stockton to Denver, spot rates on that lane hit a new 12-month high of $4.01. In the whole area, though, where the snow was mostly impacting the I-80, spot rates are up about 5 cents a mile to an average of $2.65. Of course, making news in the Colorado market was the record high 110-year sentence for a fellow truck driver. after a 2019 accident. Very high winds last week sidelined a lot of truckers. So both rates and volumes were impacted in that market last week. Outbound capacity was tight as a result. Rates are up 6 cents a mile to $1.68. Loads moved out of Denver to major destination cities, Phoenix, Los Angeles, Stockton, down a combined 22% last week following 3 weeks of prior gains. So definitely some impact from weather and protests out there. And on the East Coast, in the port city of Charleston, truckload capacity was tight last week. Spot rates jumped 10 cents a mile to an average of $2.67 after dropping steadily since the end of November. Import container volumes in Charleston are up 20% month over month as of November. A lot more vessels have been making a call in the smaller port to avoid the delays further south in Savannah. But there has been quite a big backlog. Some of the rail lines are metering some of their volumes in and out as a result of the congestion. According to the JOC today, it looks like that is now clearing itself pretty quickly, which is good news. Having a look at the refrigerated sector, focusing a little bit on the southern border to start off, load post volumes in Laredo and McAllen markets up 7% last week as a result of a 10% week over week increase in imported produce from Mexico. Reefer spot rates outbound from McAllen up 9 cents to an average of $2.67. Loads to big markets like New York City, Hunts Point, and Atlanta up to $3.11 and $3 respectively. Further north in Laredo, spot rates were up 21 cents a mile to $2.73 last week. That's excluding fuel. Having a look at the Florida market, where Chad's from, reefer capacity continues to tighten. Winter produce volumes are starting to come online. The spot rates in Miami and Lakeland up 11 cents a mile last week to an outbound average of $1.62. Capacity was very tight in the upper Midwest markets, Green Bay, Madison, Milwaukee. Reefer spot rates were up 14 cents a mile last week to an average of $3.83, almost an identical effect across Lake Michigan in Detroit markets. In Grand Rapids and Detroit freight market, spot rates are up 9 cents a mile to an average of $3.77. That's the fourth week in a row capacity has been tightening in the Michigan markets. Having a look at the flatbed market, capacity was very tight for flatbeds in California last week. Load post volumes were up 21%, spot rates up 6 cents a mile to a regional average of $2.91. In our number one market in Houston, capacity tightened slightly, spot rates inched higher to $2.66 a mile. In fact, Texas outbound load post volumes are up 11% week over week. The state average flatbed rate was up 2 cents a mile to $2.53. So tightening capacity in Texas still as we round out the year. Capacity was also very tight for flatbeds out of Florida. Average outbound spot rate jumped to 18 cents a mile to $2.16 last week. Having a look at the market further west in New Orleans, it's a big port market for flatbed carriers. They were in big demand last week. Despite a drop in load post volumes, the average spot rate climbed 66 cents a mile to a high of $3.36. High volume lanes, New Orleans to Houston, spot rates were higher at an average of $2.65 after dropping for the last 4 months. So wrapping up our market update with our year-over-year view of spot rates, having a look at dry van. Spot rates in the dry van sector remained pretty flat last week. Slightly, little bit of upward pressure during the week, but this is remained flat for sort of the third week in a row now. National average spot rates ended the week where they started at $2.60, excluding fuel, still 40 cents a mile higher than this time last year. Having a look at the refrigerated market, despite higher volumes last week, capacity is still showing signs of loosening. National average spot rate remained unchanged at $2.95, excluding fuel, about 87 cents a mile higher than the same period in 2018 and 61 cents a mile higher than the same week last year. And finally, with our flatbed market, flatbed spot rates have remained relatively unchanged for the last month. The spot rate sort of trades in a fairly narrow 1 cent per mile band, up one cent 1 week and down the next. Last week, they were up by a cent per mile to $2.57, still 35 cents a mile higher than this time last year and 47 cents a mile higher than this time in 2018. So that's it for this week's market update. Remember, if you'd like to find out more about what's going on in the freight market, go to our website to dat.com/market update and download the long form version of this week's report. So over to Ken now for the short-term forecast.
Thanks, Dean. I'm going to do my best Ned impersonation here, so I'd ask everyone listening to just assume I have 25 to 30 more IQ points than I actually have, and I'm talking a little bit faster to try to imitate our good friend Ned Damon. So, forecast. What's going to be really interesting about these forecast charts over the next couple of weeks is you're going to start to peek into that sharply correcting seasonality. And what I mean by that is right around the second week of January, dry van reefer markets especially really start to go kind of over a hill. It's actually pushed out that far due to e-commerce and the returns period. So Christmas, New Year's, you get through all of that. You have a week or two of returns, and then things really, really slow down, especially in the full truckload and LTL side in a typical year. And they did last year, too, before Texas froze over. So just FYI. So let's just level set on this chart. Blue line, historical rates observed by DAT. We got our green line is our flagship raycast model, and then we have our short term, and then our two blended. So, what you're really going to start to see here is that cresting and then contracting pattern. The green line seems to indicate that a little stronger, right? It's a more seasonally driven model. But dry van here has been on quite the rally here since the start of November, which I think has been really interesting. I'm going to move on to reefer. You're going to see an even stronger correcting pattern. I do think that green line is getting a little haywire a bit. I don't know that we're going to see this huge push over the next couple of weeks. I think you'll probably see a little bit of a blip, and then again that lull. Reefer tends to have a more pronounced lull due to that little dip you see before produce really starts to pick up in the American Southeast. Flatbed, just to get through this. So flatbed's been having that little bit of a recovery, which Dean alluded to, and I think you're seeing housing, and then that bit of a rally we had in fuel that's since pulled back a little bit. But what you're seeing is, again, a little bit of a buoyancy pattern through the holidays, and then things do slow down into January and February. Keep in mind, flatbed, you're pulling over a lot more to check the load, check the straps, the tarps. It's a more physical thing. So demand for that does tend to ebb down a bit in January, February, March, as it's cold and snowy above or around I-80 east to west. And that's the forecasts for this week. If you have any questions, please drop them in the chat or comment section below, and we can dig into them. But with that, I'm going to turn it over to Dean to tee up our question of the week. The last one of the year.
Yeah, it is. Yeah, thanks, Ken. It's quite an appropriate question of the week this week around some of the the things we're working on in the shipper market. Also, impacts carriers indirectly, but shippers have been reporting double-digit rate increases for the last 5 quarters. Some of them in our recent survey that Chad's division conducted, a little bit of pessimism around when they think the market's going to turn. Some of them expect it to take well into 2023. About a quarter are saying it'll be sometime this year in the second quarter. So, capacity from a shipper's perspective, capacity is extremely tight. And that's one of the things that we hear over and over on our roundtables is trying to find carriers. Where are they? Where did all the drivers go? All sorts of questions being arisen. So, Chad, I'll throw it over to you to talk about some of the products you're working on this year and how that might address some of the shipper demand issues that we're seeing.
Yeah. Go ahead, Ken. Yeah, it's a perfect intro. I appreciate it. Ken, is there something you wanted to add?
Yeah, I was just going to jump in to absolve you of any internal liability and kind of caveat this as a bit of a rule-breaking exercise. We just wanted to share. I mean, we've got so many cool things. It's our time to do annual planning. And when we're really sitting down, there's this whole discipline in data science and analytics around recommender systems. So if you think about it, like when you log into Netflix and you click on a movie, maybe by accident, and you get really frustrated because it's going to give you a bunch of Spanish romantic comedies, right, in your algorithm. Those are all recommender systems behind the scenes. So DAT is unique in the sense that, sure, other companies out there are launching other rating products with dozens of contributors. We're scared of that, right, with our 1200. But what they really can't do is blend our 3-sided network with that. So blending the rates in the network, right? We have shippers, carriers, and brokers all operating in our ecosystem. And 2022 is really going to be a focus here for us of making the whole freight match, carrier sourcing, if you're a carrier finding freight, that whole process easier. Instead of looking through hundreds of loads on a search, we're recommending things. So this one's probably the most far along, for lack of a better term. And this is the shipper carrier side of the equation. So with that, I'm going to turn it over to Chad and walk us through what he and our data science team have been working on for the past couple months, I'd say, right?
Yeah, great. I appreciate it. So yeah, very early stages here. So what you're looking at probably looks like an eye chart, and I'll explain it a little bit to you. But before I do that, I'll just go into kind of the problem that we're trying to solve here. So as Ken said, we've got a 2-sided network. So we have shippers on one side, we have carriers and brokers on the other side. So 3 parties at play here. And so what we're doing is we're trying to overlay those networks and find matches. Right. So a typical shipper, the problem that they face is they want to add capacity to their network. They want to add carriers to their network. So we're not normally talking about a ton of carriers. So a typical maybe $50 million a year shipper might have 50 carriers in their network. And maybe 5 of those are brokers tapping into the broader capacity market and helping them out with spot and that sort of thing. So what they're looking to do is to maybe add 10, 15, 20 tops to their network. So we're trying to help them find those carriers that are a fit for their network. With the a market as large as it is, well over 100,000 carriers out there in the marketplace, it's quite difficult for them to narrow down which one should I contact. So if we look at this dashboard, that's what we're trying to help them do here. We're trying to solve that problem. So at the very top here, we have shipper submitted data. This is all demo data, so it's all fake. And so you see a list of lanes at the very top. These are lanes sorted by how well this shipper's performing versus our benchmark. So the worst performing lanes are at the top. And then down below, just below that, you can see with the little faded out block there, carrier recommendations. So these are the carriers that we're recommending on those 9 lanes that you see at the top. And then to the far right corner, you can see their incumbent carriers. So they get a view towards who's running these lanes for me now and who could run those lanes for me in the future. And I apologize for the grayed out block there, though. We're just keeping everyone's data anonymous, so we've hidden some of the carrier names. So if I apply a filter on any one of these lanes, so we've got a Mercury to Black Canyon lane here filtered, then it would just below that filter out the carriers that would be a fit for that lane. So I can see that I have 3 incumbent carriers on the far bottom right. And then to the bottom left, I can see a recommendation of 20 carriers that would be a fit for that particular lane. So, and we're giving them a lot of information about the carriers that we have from our databases and also FMCSA. So we can tell them the truck count, if this shipper's been used by another DAT, if this carrier's been used by another DAT shipper, if they're SmartWay certified, veteran owned, all of that good information that they want to be able to filter by. One other really cool way about for a shipper to solve this problem is it's difficult to see, but so in this example, I filtered on a recommended carrier, and then the shipper can see all the lanes that recommended carrier would be a fit on for them. So, they could export this lane list out to Excel, email that to the shipper. We've got the email address right here for them. Email that to the carrier and get rates back as a first step to try to test, are we a fit together? So this is, I think, a good example, again, in the very early stages of us using data on the shipper side and bringing it in. So we don't have anything to sell quite yet, but we're still in the research phase of this, hoping to bring something to the market in Q1, Q2.
That was awesome. Thank you, Chad. So if I'm the shipper, right? So you joined us through FMIC. I guess we didn't do a really long form intro. You joined us when DAT acquired FMIC. And prior to that, you were at CHEP, right? The pallet company. Can you talk a little bit about kind of your prior role and how you may have used this tool when you were, to hide the names of the innocent, right? But theoretically, how would you have used this when you were in the industry? Yeah,
absolutely. So I was at CHEP for about 10 years. I was with a small regional carrier, Gene High Trucking, for about 5 years prior to that. When I was at CHEP, we would have used a tool like this to find and add carriers. So we did find that sometimes in our network, that the small regional carriers were a better fit in certain areas of the country. So finding those carriers is quite difficult. There's different databases out there, but the ability to overlay this and not only find a carrier that's located in the region, but also to know from the DAT load board data that we have that carrier is searching for loads and posting trucks on the lane that I'm looking to fill is incredibly valuable. It just skips a lot of steps and gets you quick, to the answer that you're looking for quicker. So we ran initiatives like that to grow our carrier network, to improve service. So this would have been a really valuable tool for us then.
When I was in the industry, you spent so much time combing through those lists, and the FMCSA database is just notoriously, for lack of a better term, just like unkept. There could just be weird things in there, and if you don't know your way around, it could be a really daunting place to go comb through, right?
Yeah, definitely. And so we would run into that quite a bit as well, and you get some misinformation in there. And then, just having that match already confirmed for you that this carrier is running a dry van lane on the lane you're looking to source a carrier for saves a lot of time and would be much more helpful. So, the FMCSA, it's helpful. So we even link this to their website. So it's another piece of information that a shipper can use to gain information about the carrier before they reach out to them.
But there are hundreds, if not thousands, of lines of code that our data scientists have worked on to kind of clean it and correct some of the weird things that we see and validate it against our own internal network. So that's like a lot of the work. In a lot of ways, what DS does, right, data science does, is it saves the frontline folks from doing a lot of that work. It does it programmatically, and it does it almost seamlessly. Data science done well, you really don't even know that it's really doing anything, right?
That's right. Yeah. One of the things that you might not have seen in there was, we rank the carriers, so we provide a 1 to 20 rank on every lane for the carriers, and the data scientist team has done an amazing job of building an algorithm to fit that rank. So you don't need to know how the sausage is made, so to speak, but you can be assured that that's most likely the number one ranked carrier is going to be the best fit on your lane.
Right. So, Dean, as a carrier, right? You usually give us the carrier voice. I mean, this is a great marketing tool for you, right? To kind of bubble up to the top. If a shipper may have never found you before,
right?
So, think about. Can you talk us through how how excited you might be to get a call from a shipper out of the blue that they may have found you through this tool?
Yeah, I think it's one of the great tools that we can start to adapt. Maybe not right now because capacity is so tight. And from a carrier's perspective, they'll really need this tool when the market tightens, loosens, and then shippers start to get pricing power, and then they've got more carriers than they've got loads. So what carriers will be wanting to do with this tool is start to lock in more longer-term contracts with bigger shippers. So what it does for them is it just helps build some depth into their network and helps find carriers that they might never have been able to identify, especially for smaller fleets who don't have a big back office staff. This is a great tool because it's a good outsourced tool that they can use to essentially do some of that marketing for them that they might not normally able to be either afford to do or have the people to do in their own shop. So I think this comes into its own for carriers when the market starts to loosen sometime this year, I expect.
Yeah, and we have a whole docket plan. I mean, this was just, like I said, the tip of the iceberg, the most demoable today, I would say. And Chad was one of the people that wasn't on vacation today. So we kind of made that calculus of what we were going to show. But brokers are not going to be excluded in any way from this. We have an entire tranche of work focused around, recommending carriers to brokers, right? Their needs are different. So rather than have like a one-size-fits-all algorithm that recommends any carrier to any sort of person looking for a carrier, we're building separate suites of algorithms that tailor what a shipper might be looking for versus what a broker might be looking for. So that's coming down the pike in 22. And then we didn't forget about our carriers, right? So we don't want this just to be a second order derivative benefit to a carrier where you might be found. We're investing heavily in data science. We've already been pretty well levered for a company our size, but we're only going to get bigger. Recommendation systems for carriers. So you log on, and instead of poking through trying to find the best place to move your truck, what's the best load for you? How can we bundle loads together? How can we do things to make it easier to be profitable as a carrier? Again, do not assume that these market conditions will persist. There's a reason why historically trucking companies have had low single-digit operating ratios. This is an anomaly. We will go back to some sense of normal in terms of carrier profitability. So these tools, you might be thinking, I don't need this now, but maybe by late 22, if fuel stays high, you might be looking for ways to maximize miles, minimize deadhead, and just, again, it's all about keeping those wheels moving profitably. I know I'm grossly oversimplifying the entire business model for carriers, and Dean's probably cringing, but... Anything else you want to add, Chad? I thought that was great. I mean, we had to blur some of the stuff out to protect the anonymity, but it was really great. Anything else you want to sort of...
No, I'm excited about it. We're starting to get some information back from a couple of test customers that we're working with, and it's exciting that we're getting really great feedback from them. And to your point about brokers, this is not just recommending asset only; it's also recommending brokers to the shippers as well. So if there is a desire for a shipper to add a broker, which we do run into that for sure, it's making that recommendation as well.
I didn't even know that. I mean, I learned something today. So they have. I guess we could take it offline. That's very interesting. I mean, given what's happened in the last year and a half, we've seen record kind of like new broker participation with shippers. So, I mean, that's a great feature out of the gate.
Yeah. We're getting good feedback on that as well.
Cool. All right, Dean, you want to play Ned's role here of
Sure.
teeing us? And again, if you have questions, we have probably 3 or 4 of them in here, and we have room for a few more. So if you have any questions before the end of the year, drop them in, because we won't be here next week.
Yeah. I've got a great question. We kind of get this one every week around sprinter vans and, smaller box trucks from Corey Pace, specifically around Houston. Corey, we'll have to get back to you. If you want to shoot us a note at askiq@dat.com, we'll have a nose around and see if we can find something. Nothing comes to mind specifically around the Houston market. I think we've got a good question here from Minister Bergovich. What's your expectations for the first quarter in 2022 for dry vans? So maybe I'll tee that up, Ken, with where we were this time last year. We kind of end this year, spot rates for all 3 equipment types are up 45 cents a mile higher than the same week last year. Contract rates are up about 31 cents a mile. As we started the new year last year, first quarter, spot rates dropped about 25 cents a mile by the time January rolled around, the end of January. So that was a sort of a seasonal dip that we normally see. But that was from a high of $2.25 a mile at the start of this year. We'll probably start out the first week of 2022 around 35 cents a mile higher. So any sort of down movement that we see will be from a much higher place as we head into the first quarter. Of course, last year or this year in February, we had the polar vortex event cause an acute capacity crunch, and the market never really recovered from there. So it's in terms of what weather does, that's the wild card that we have out there. But generally, we should see some downward pressure on spot rates given normal seasonality that starts off the shipping year. Ken, what do you think?
I think Q1 will feel slow. Even if we don't see enormous rate contraction or pullback on volume. I think it's been a while. Since things have. I mean, it's been since February of 21, really, since you could describe things. There really hasn't been a week we've come in here, put our headphones on, and said, "Boy, it's slow out there." Since we were kind of talking about the pullback in early February of last year, so it's coming up on a year, which is really uncommon. I mean, even in like the busy years of 18 and was it 16 before that, post Christmas, post 4th of July, that little lull between Halloween and when things really picked up for Black Friday and Christmas. I mean, those time periods are generally pretty slow weeks, or even kind of strings of a couple of weeks. But I do think Q1 will feel slow. Chad, what do you think?
Yeah, I think that makes sense seasonally. We see that just about every year, especially in January. It'll be interesting. Many of our shippers that we see will roll out their new bids, start to execute on their new major bids, their annual bids, February, March. So it'll be interesting to see how those take hold. Usually there's some initial shakeout on those and some spot activity as those settle down. And then those contract rates start picking up and get traction. So it'll be a very telling quarter for sure.
Right.
Yeah. Hey, Dean, before we skip ahead, going back to that sprinter van question, we should try to get someone on from one of the major expeditors. Again, I'm not going to show any favoritism or bias, right? So sprinter vans, by far, the best place to go with a sprinter van would be one of the big expedite companies. And you have Load One, FedEx Custom Critical, Panther Premium, which I don't know if they've changed that name to assimilate into ArcBest much at all. I may have already said Load One. XPO has a division. We have Bolt, Prime. At that point, you're starting to get pretty. Canberra, I think, is another one. I mean, I think that's really where your best bet is to lease on. And you should have no problem finding freight in Houston at all for expedite. There's a ton of stuff happening down there. You can even kind of jaunt up into the southeast, and there's a ton of, that's like the new auto renaissance that happened down there with Volkswagen, Mercedes, BMW, Volvo, Nissan, right, has a huge presence down there. So I mean, those are all major expedite corridors for sprinter vans. Just something to think about. And maybe we can find someone, I know you're pretty well connected in that industry, Dean, to come on and talk about.
Yep, we'll do that. The other point around Q1, I talked to a friend in Beijing last night in the insurance industry just to get a sense of what's happening during Chinese New Year. As you know, typically it shuts down or the manufacturing industry shuts down for 3 weeks, a week either side of the actual celebration, typically to allow people to go back to rural areas where their families are from. He said last night that people are being banned from travelling outside of their current areas. So it looks like we'll see a repeat of this year where people didn't travel home during Chinese New Year and kept working. Factories stayed open this year for different reasons. We may see a repeat of that this year, which will continue that flow of goods across the Trans-Pacific during this inventory replenishment phase in Q1. So we still should see some pretty good activity in port markets overall, would be the other thing to consider there.
Yeah, I don't think LA is going to feel slow in Q1. I think they're going to be dealing with that backlog. I just think a good portion of the country will get back to seasonally taking a deep breath, if you will.
Yeah, they've still got around a month's worth of inventory just sitting, waiting to get in. They normally bring in around 900,000 TEU a month. They've got just over 1 million in that pipeline heading back out across the Pacific. So it's going to take a while for that to clear. So I think we've answered the next question, Ken, around Supreme Logistics, question around prediction for dry van market. The other thing production data that's just come out from the Federal Reserve looks pretty good. The manufacturing side of the economy is pretty upbeat. They've just had another second month of increases. So there's pretty good predictions there on the industrial side of the economy. Question from Michael Hain. That's a familiar name. What are your...
He's dead to us. Don't read the question.
What's that, sorry?
I said he's dead to us. Don't read the question. I'm just kidding. Go ahead.
Yeah. It's an interesting topic around autonomous trucking. What do we think about autonomous trucking, and if we see an impact on capacity?
Why don't you start this one, Chad?
Right.
Oh,
we've answered this one 100 times.
Yeah. I don't see anything coming very soon. At least for a few years. It's on the horizon. So I'm not expecting any type of immediate impact. Everything that I've heard is when it does come, it'll be just on that highway exit to exit move.
Yep.
Maybe extending some of the hours of driving for drivers. Will there be a day where the driver can get in the back of the cab and take a nap while the truck's still moving? Maybe in my lifetime, probably definitely my kid's lifetime. But,
I think that's probably right. I mean, the harbinger for me, maybe it's just having a bias coming from that industry, is we're going to have to see like autonomous air freighters first. You know what I mean? I think people are going to have to get comfortable with that. That's a much more low risk dissociated thing for the public to get a hold of. I think having 85,000 pounds of steel barreling down the road with no driver is a really hard psychological barrier. And then you have the regulatory barrier. So you're going to have to this country's huge. I mean, you're going to have every state from, I think about, New York to Washington, accept the same regulatory similarity to get what I-90 runs through all of those states. So that's going to be tough. And then infrastructure. We can't agree that we need to patch potholes and fix bridges, let alone add extra lanes. And you can't just, these exits, you can't just do a park and go with autonomous. There's going to have to be, because they're most likely going to be electric. So the infrastructure required. So yeah, I'm going not in my career lifetime.
Yeah, I'm with you.
Will it make a dent? It'll happen. You'll see some novel, like everyone will declare victory because you'll have like LA to Reno on an autonomous lane. But I don't think you'll see broad interstate commerce happening that way in my career.
Yep. I mean, they cost a ton of money too. So I think it's going to be a large fleet investment. We'll see an impact on truckload capacity in small segments of the industry where some of those fleets can afford to adopt the technology. But I wonder, as soon as the market loosens and we've got more trucks than loads, does the need for this technology disappear? This market's incredibly cyclical, and we tend to go through periods of tight labor markets and loose labor markets. I've seen the same with fuel saving technology. When diesel's relatively cheap compared to what it is today, the impact of technology that sort of impacts MPG is sort of less. I wonder if it'll be the same thing when the market loosens and the labor market eases up.
I think that last part though only holds a ton of water in a sane kind of capital environment. I mean, we could probably raise $10 million to do this show. I mean, you know what I mean? Right. In this environment, money is so cheap. PE is so kind of agnostic to profit. I don't doubt that if you came up with a good idea for, what was that, Nikola? Did they even ship a truck? Didn't they raise all that money, go public, and they still haven't shipped? I mean, I could be wrong. It could be a different company. And then the guy's going to go to jail, that Trevor Milton guy? I don't know. I got more important things to worry about. But I mean, I just, I don't know how you go public and then you don't even ship a product. Or that's Lordstown Motors.
This conversation hasn't progressed much over the last 5 years, right?
No.
I think we would have had the exact same conversation about 5 years ago when it was initially getting hyped. So it'll be interesting in the next 5 years, see what happens.
I lied. 22 hours ago, Nikola delivered its first electric semi-truck to a customer.
Okay.
There you go. I'm wrong by 22 hours.
Yeah. That's all we got on the question front, Ken.
We're on record. What was your annual prediction for spot rates by the end of the year, Dean? Mine was, I think, negative 15%. Caplis's was 20. What was yours?
I was 25 negative. I was down 25.
Okay, so maybe Caplis was 20 and I was 15, or maybe Caplis was 15 and I was 20. So we were all, and then Ned was wrong. I think he said like 5% or flat. So what's your prediction? Because we do have a question there about the total year. So Chad, end of the year, where do we exit year over year spot rates?
End of year 2022.
And like this time next year, where are spot rates sitting on a year over year basis?
Year over year, I think they'll be down, I would guess 15, 20%.
Yeah, I think that's probably where most. It's just going to be so hard to lap where we are today.
Yeah, the base is so high. It's got to be down.
So I'll toss you a softball since this is what you do every day. Contract rates, given inflation and all that kind of stuff, where do you see contract rates and what you're sort of seeing with RFPs being executed at the moment?
Yeah, I would say they're probably going to be flat to, I wouldn't say down. I would say flat to +5 by the end of the year.
Okay. Yep,
I vaguely recall our predictions landing, that 5 to 15% up.
Yeah.
I think Chris had a hot take on that. I think he was pushing like 15, 20% up for contracts.
Yeah. Yep.
Maybe he knows something we don't.
Yeah.
All right. Well, I think that wraps us up. Anything else, Dean? Someone asked for a question. So email address, that's askiq@dat.com. Again, the collective IQ of that inbox is at well into the thousands, if not multiple thousands. So all of our analyst team monitors that thing. Yep. So askiq@dat.com. As long as you're not trying to sell us website design services or off-label prescription medicine, we will forward your email off to the team and you'll get a response in a couple days, if that. Anything else, guys?
Yeah. Thanks for having me on, guys.
Yeah, thanks for coming on, Chad. So, again, no show next week. We will pick things back up in the new year. If you have any ideas for guests, if you yourself want to come on the show and talk about something interesting, feel free to get a hold of us. Ask IQ is as good of an inbox as any to do that. Dean's written updates are available. Again, all of our big annual predictions, you can either check out the last Freightvine episode or our last IQ. They're all up on the website. That's where we went into some more detail about annual predictions. So if the folks that ask those questions want some more reasoning, you can go there.
Yep.
But with that, we truly have a blast doing this. We hope we can do another 50 episodes of it next year. We hope all of you have a great holiday season. Be safe and take care. And we look forward to talking to you in 22.
We should just mention a shout out to the special show we've got this Saturday on Christmas Day on Sirius XM. They're doing a live show all day. A lot of truckers will be out there driving on Christmas Day, so we'll be on at 8 a.m. We're also on 8 a.m. Thursday this week on Sirius XM channel 146. We're on landline now tomorrow night at 8 p.m. Eastern. Stephen Pettit will be online. And we've got the Mark Willis show next Thursday at 2 p.m. Eastern. So lots of DAT market insights on the Sirius XM channel 146 in the next 7 days.
Awesome. Thanks for catching that, Dean. I totally spaced on it. All right. Bye, everyone. Happy holidays. See you in 22.
Okay.
Thanks.
Bye.
Okay. Bye-bye.